Gold just had its worst two-week collapse since 1983. Bombs are falling in the Middle East. Oil is above $100 a barrel. The Strait of Hormuz is closed. And gold, the one asset that every financial textbook, every advisor, every television anchor tells you is the ultimate safe haven in exactly this kind of moment, is down nearly 20% from its all-time high. I want you to sit with that for a second, not because it is confusing, but because if you do not understand exactly why it happened, you are going to make the wrong decision next. And in a market moving this fast, the wrong decision costs more than the crash itself. I have been navigating debt cycles and monetary transitions for more than 40 years, and what I am watching right now is not a breakdown of gold. It is a test of whether you understand the difference between two markets that share the same name, and almost nobody teaches you that they are different. I call this the two gold problem. And what I am about to show you is the most important thing you can understand about precious metals in the next 12 months. Let me begin the way a teacher begins, not with a prediction, with a mechanism. Most investors carry a simple mental model of gold in their heads. War happens, fear rises, gold goes up. It is clean, it is logical, it is also dangerously incomplete. Because that model describes what gold does over a cycle, measured in years. It does not describe what gold does in the short term, when three specific forces align against it simultaneously. Those three forces aligned on March 18th and 19th of 2026, with a violence that wiped out months of gains in days. And the investors who sold into that collapse, who looked at a falling price during a war and concluded that the gold thesis was broken, made the most expensive category error in personal finance. They confuse the short-term mechanical price with the structural price. They are not the same thing. They have never been the same thing. And the gap between those two prices is exactly where generational wealth is either built or permanently surrendered. Gold hit an all-time high of $5,589 per ounce on January 28, 2026. As of this week, it is trading near $4,320. That is a decline of roughly 20% in less than 2 months. 7 consecutive losing sessions, the longest losing streak since 2023. And during those 7 sessions, Iran's Revolutionary Guard threatened to close the Strait of Hormuz. Oil pushed above $100 per barrel. Bombs fell on Tehran. The Middle East entered its most serious military escalation since 1973, and gold fell every single day. So either everything you believed about gold as a safe haven is wrong, or there is a mechanism operating underneath this market that most investors have never been taught to see. The mechanism is real, it has a name, and it is older than any of us. The number you need to understand is not the gold price. It is 4.25. That is the current yield on the United States 10-year Treasury bond. And that single number explains more about why gold is falling during a war than any analysis of the war itself. Here is how it works. The Federal Reserve held rates steady on March 18th, but more importantly, it revised its 2026 inflation forecast higher to 2.7%. Chair Jerome Powell explicitly identified energy price spillover from the conflict, from oil above $100, as justification for maintaining a restrictive policy stance. When the Fed says higher for longer, bond yields rise. And here is the part that almost nobody explains clearly. Gold produces no income, no interest, no dividend. It simply holds its value over time. When Treasury bonds pay 4.25% annually, with zero default risk because they are backed by the full credit of the United States government, investors face a real mathematical choice. Hold gold that pays nothing, or hold treasuries that pay 4.25%. When that yield is low, 1%, 2%, gold wins easily. The inflation protection and the store of value more than compensate for the lack of income. But when yields hit 4.25% and the dollar strengthens simultaneously, the arithmetic of holding gold becomes genuinely painful. You are paying an opportunity cost of 4.25% per year to own an asset that just fell 20%. That is not a safe haven calculation. That is a penalty. And the market priced that penalty in almost instantly. Now let me show you the second mechanism, the one that turned a correction into a crash in a matter of hours. I call it the leverage unwind. For months, market participants had priced in at least 3 rate cuts for 2026, betting that cooling inflation would give the Federal Reserve permission to ease. When the dot plot shifted upward, when the median projection for year-end 2026 rates moved from 2.9% in December 2025 to 3.4%, the message was clear. The Fed is in no rush. Now, throughout 2025 and early 2026, retail investors poured more than $70 billion into gold ETFs. A significant portion of that capital was in leveraged products, 2 times and 3 times ETFs that multiply the daily move. These products have a design feature that most investors discover only when it costs them money. They rebalance daily. When gold falls, the leveraged ETF must sell to maintain its ratio. Lower prices trigger more selling. More selling creates lower prices. The cycle accelerates until the leveraged position is fully liquidated, which can happen inside a single trading session. Gold initially spiked from $5,296 to $5,423 on the Hormuz news, then reversed hard, down more than 6% from the intraday high. Paper traders flushing positions. Nothing more fundamental than that. The very products that helped retail investors ride gold to record highs became the mechanism that crashed it back in 2 weeks. The retail investor was not selling because they changed their mind about gold. They were selling because the product they owned gave them no other option. And while that was happening in New York, something else was happening quietly on the other side of the world. In 1983, gold suffered one of its worst weekly declines in decades. The reason was not a financial crisis. It was Middle Eastern oil-producing states selling gold to raise cash because their oil revenue had collapsed, because oversupply from North Sea oil and Alaskan production had destroyed their income. Saudi Arabia, Qatar, Kuwait. They needed dollars to defend their currency pegs and fund their governments. They sold gold. That selling flooded the market and triggered a collapse that looked, from the outside, like a complete breakdown of gold's safe haven properties. The mechanism in 2026 is the same, inverted. Oil is at $100, not $30. But Gulf states cannot physically ship their oil because the Strait of Hormuz is disrupted. Storage is full. Revenue has collapsed. Not because the price is low, but because the pathway is blocked. Saudi Arabia holds 323 tons of gold. Qatar holds 115 tons. Kuwait holds 79 tons. These are not small positions, and they do not need to sell all of it to move the market. They need to sell enough to cover the cash flow gap created by a disruption nobody anticipated would last this long. The same governments that built gold reserves for exactly this kind of rainy day are now experiencing exactly this kind of rainy day. And they are doing exactly what they did in 1983. The 1983 playbook, run by the same players, for the same reason, in an inverted version of the same oil crisis. Most people reporting on this crash have not connected those dots. There is a third layer operating simultaneously. I call it the algorithm amplification. Hedge fund algorithms do not care about geopolitics. They care about 2 numbers, the dollar index and the 10-year Treasury yield. When the dollar index climbs above 99, the algorithm sells gold. When the 10-year yield rises above 4%, the algorithm sells gold. On March 18th and 19th, the dollar index climbed toward 99.9 and the 10-year yield jumped to 4.25%. Gold, a non-yielding asset whose entire bull thesis rested on falling real yields and a weakening dollar, repriced accordingly. Billions of dollars in paper gold contracts were sold automatically. Not because any human decided the gold thesis was broken, because the preset conditions for selling were triggered simultaneously across hundreds of algorithmic trading systems that do not read newspapers and do not know there is a war. The war actually made gold's situation worse, because the war drove oil above $100, which drove inflation fears, which drove the Fed hawkish, which drove yields to 4.25%, which drove the algorithm to sell. The war did not save gold. The war is precisely the reason gold is falling. Now, here is what I find most important about this crash, and what I have observed in every major gold correction over 40 years. The paper market and the physical market are telling completely different stories. The Spider Gold Shares ETF gapped lower on high volume. Silver hit a 6% lower circuit. The paper market spoke with one voice this week. Yields up, dollar up, sell. The physical market spoke differently. Physical gold premiums stayed elevated. Demand from institutional buyers, central bank programs, and long-term holders held steady. The Shanghai Gold Exchange continued trading at a premium to the COMEX paper price. Asian central banks continued their purchasing programs without interruption. When I have observed this divergence in my career, paper selling hard while physical demand holds, it has historically marked not the end of a bull market, but a transfer of ownership. Leveraged retail positions moving to unleveraged institutional and sovereign buyers who are comfortable waiting. That transfer is not pleasant for the person being transferred out of, but it is the mechanism. And it is as old as markets themselves. I want to address something directly. Some of you are thinking, if the structural case is intact, why are JP Morgan and Deutsche Bank not cutting their price targets? That is exactly the right question. JP Morgan's year-end 2026 target for gold is $6,300 per ounce. Deutsche Bank stands behind $6,000. Neither institution moved those targets after March 18th. Neither bank withdrew their projections after the worst weekly fall in 6 years. The institutions that set those targets had access to the same Federal Open Market Committee decision, the same dot plot revision, the same oil shock data that every retail investor was reacting to. They looked at all of it and did not change their numbers. That is the signal I watch, not what institutions say in press releases, what they do with their price targets when the short-term price moves against them. The answer this week was clear. They held, because JP Morgan and Deutsche Bank understand the difference between a tactical event and a structural change. The dot plot changed on March 18th. The structural case did not change. Central banks are still buying 863 tons of gold per year. The United States is carrying $36.2 trillion in debt and paying more than $1 trillion annually in interest, the first time in American history that interest payments have exceeded the defense budget. At 4.25% rates, the United States is rolling over $9.2 trillion in debt this fiscal year at a cost of $391 billion more than it cost at 2% rates. The arithmetic of sustaining 4.25% rates against a $36 trillion debt load is not indefinitely maintainable. The moment that arithmetic forces a policy response, a rate cut, a form of yield curve control, a return to quantitative easing under whatever name the next Fed chair chooses, the mechanical headwind against gold reverses. And when it reverses against the backdrop of central banks buying at record levels and JP Morgan maintaining a $6,300 target, that reversal will be fast, violent, and will recover this correction and more. So let me tell you the two numbers I am watching, not the war, not the daily price, the dollar index and the 10-year Treasury yield. When the dollar index breaks back below 97, and when the 10-year yield breaks below 3.5%, which happens when recession fears override inflation fears, or when the Federal Reserve is forced to cut, the mechanical selling reverses. The opportunity cost of holding gold collapses. The algorithmic triggers flip direction. And the physical demand that held through this entire correction becomes the foundation for the next move upward. I do not know when those two numbers break. I do not trade on timing. But I know what the arithmetic says about the sustainability of 4.25% rates against $36 trillion in debt. And I know what history says about what happens when a paper market crash diverges from physical demand in a structural bull market driven by sovereign accumulation. History says the divergence does not last indefinitely. It never has. I want to end the way I always end, with time, because time is the one thing that no price on any screen can replace. I want you to imagine that you are sitting quietly, looking back at this week in March 2026. Gold fell 20% from its all-time high during a war. Everything in you said, sell, get out, the rules are broken. And the question I want you to sit with is not what the market did next. The question is whether you understood what was actually happening while it was happening. Did you see the mechanism, the yields, the dollar, the leveraged ETF rebalancing, the Gulf sovereign selling, or did you only see the price? Did you confuse the paper market with the structural market? Did you sell a physical property because a paper price moved, the same way someone might abandon a house because a real estate index fell in a single quarter. The price changed. The property did not. In a world where almost every financial asset carries counterparty risk, the risk of a state, a central bank, an intermediary failing its promises, gold remains the only asset with no counterparty. It makes no promises. It pays no interest. It is not dependent on any political decision. It simply exists. And that is precisely why it provides security. That statement is as true at $4,300 as it was at $5,589. The paper market crashed. The structural case did not. In 40 years, I have never seen those two things remain separated indefinitely. You now understand why they separated. That is more valuable than any prediction I could offer you. The door to understanding is open. It has always been open. Most investors simply never walk through it. That is all. Thanks for watching.